Venture Club
Yeah, it was
meeting.
early summer.
Is that what it was? And he asked me if I would come and speak to your group, and I said, yeah, I'd love to. Always like to help people try and understand insurance and, you know, why they need it, and what kinds of insurance there are out there. I have to apologize. I was scheduled last month and I couldn't make it because I came down with a migraine. So if anybody can invent a cure for migraines, I will be your first customer.
Well, there's that one.
What's that? Well, that's, I don't know that that's a cure. It can
Well, not
definitely
cure,
help.
you forget about it.
Right. All right, well, go ahead and get started here. Very quickly about myself. I've been a commercial insurance broker for about 10 years now, I guess it is. Prior to that, I was a risk manager at a large retirement community up in Boulder, so I was the one making the purchasing decisions about insurance. And ironically, when I was younger, I actually had a small business, and my partner was a patent attorney, and he invented he sold gun cases. And so he invented a mechanism by which to attach gun case to a bed frame. And of course, he patented everything about it. So I've got, you know, a lot of experience. Literally, we ran this business out of his home for a couple years, and then moved into this small manufacturing space. And so I'm aware of all of those challenges. But kind of what we're here to talk about tonight is just kind of an overview of insurance for inventors, and this could really apply to any small business owner. The concepts are very much the same. And if you have questions, feel free to jump in. You know, the only thing worse than talking about insurance is hearing somebody drone on for 45 minutes about insurance. So feel free to jump in when it makes sense. So why do I need insurance? A lot of people go without insurance, and that is certainly one acceptable solution. But, you know, why might I want to spend money that I could spend otherwise on insurance? It's a good question. What types of insurance are out there, and what might make sense for my business? And then finally, a question that I get asked quite a bit is, what kind of limits should I be looking at? So very quickly about us, this is not my company. We're Signature Select is a part of IMA Financial Group. IMA is the 13th largest privately held brokerage in the country, and I think we're 24th or 25th largest brokerage, period. We place about $1 billion in premium on behalf of our clients, and my group within IMA focuses exclusively on small businesses and startups. So I work with people who, you know, have an idea and are just starting out. I work with people all along that, you know, kind of continuum, and then, you know, if they grow their business up to a certain point, we transition them into our middle market group where it makes a little more sense for them to be. So my company can help people regardless of where they are in the growth cycle. So why do you need insurance? Well, that's one of the reasons why you need insurance, because some guy in a giant dump truck might run over your car. But really, all kidding aside, the reason you need insurance is because bad things happen, right? People can get hurt, things can get damaged, and if what you do causes damage to somebody else, you can be liable for that. In fact, you probably are liable for that. And you probably, even if you're not liable for something, you can get dragged into things through no fault of your own. And that is a long and painful process. Has anybody had the joy of dealing with an insurance claim, like not a fender bender on your car, but like a large insurance claim? Well, that is fortunate. In my risk manager days, actually 3 months after I was hired in that position, we had a van accident. One of our drivers was taking a group of residents on their regular Tuesday tour up to Estes Park, and the van got tangled up with a tow truck, and they both ended up off the side of the road. Multiple injuries and 2 fatalities. And it was a massive drain on the organization. Of course, the people who were involved were just crestfallen, and it was a lot to deal with for us. So those kinds of things can happen. With respect to products liability, which is what we're really talking about here tonight, you know, the possibility that your thing might hurt somebody. It can be a design flaw. You know, there could be an inherent issue in the product that somebody just didn't catch, and that could cause the product to fail, not work properly, and that could cause somebody to get hurt, right? A defective product, you know, there could be a manufacturing error. You know, the design called for this material, they used a different material. You know, it wasn't strong enough as a result, so the product failed. Now that's a liability insurance situation. Or insufficient or incorrect warnings. You know, don't put your hand in the lawnmower while it's running. You know, for some reason you have to tell people that these days because they can't figure it out on their own. But, you know, right, wrong, or indifferent, that's kind of where we are. You have to tell people not to do things that they should know better not to do. And if you don't do that, you can be held liable. So people can get hurt, things can get damaged because of your product, and people can also lose money as a result of your product. Investors, for example. Somebody drops a couple $1 million to fund your company, and you end up out of business because there was a flaw in the product that nobody caught along the line. That investor could come after you. They probably will. They're going to want their money back, right? The users of your product or service. If you, you know, if you were a computer hardware manufacturer of some type, and banks use your hardware, and it fails, and the banks can't process transactions for a period of time while they're getting that fixed. That bank is going to lose money because of that. Who knows how much money they could potentially lose because of that. They're going to look back to you as the manufacturer for that. That's an insurable risk. And then finally, competitors. You know, you could infringe on a product of theirs, and they could come after you for indemnity for that. There's all kinds of reasons why you might need insurance, but the key takeaway from that is that people and things can get hurt, and that's what insurance is for, you know, to indemnify when that happens. Any questions? Okay, so you know, as you guys know, there are all kinds of types of insurance out there. I mean, you can get insurance for your pet. You can get, you know, my company used to have a sports insurance brokerage that we owned, and so we insured pitchers' arms, and we insured kickers' legs, and you know, we would insure specific body parts on people because, you know, those are worth a lot of money.
On pro athletes?
Yeah, pro athletes, and even some college athletes. You know, which was a lot of fun. And I'd be looking something up in our agency management system, and I'd run across, you know, a player who used to play for the Avs or something like that. It was pretty cool. But you know, we're not talking about that type of stuff generally here tonight. But the types of insurance that you as inventors, as small business owners, as manufacturers might be looking for are general liability, and I'll get into this in a little more detail about what general liability is. Product liability, of course, if your product causes damage to somebody else. Errors and omissions, which is a coverage designed for monetary losses only. Intellectual property coverage, and then finally directors and officers. And I'll get into these in a little more detail here as we go along. So general liability. What is general liability? You've all got auto insurance. You've got probably maybe got homeowners insurance or renters insurance. Those products both have a liability component to them. Liability coverage is what's called in our world a third-party coverage. It responds when somebody else gets hurt and it's your fault or your product's fault. If you've got a homeowner's policy, your home burns down, you get a new home. That's property coverage. That's first-party coverage. Liability is third-party. I'm playing your game, and somehow I hit my head and I get hurt. I'm the third party. I say your game caused me to get hurt. I'm going to sue you. Your general liability policy is what's going to respond. And the trick with general liability, every insurance policy has what's called a trigger. It's the thing that makes it pay, right? In the case of homeowners, it's damage to your home. Hailstorm, fire, that's the trigger. The policy pays. General liability responds to bodily injury or property damage to a third party. And that seems pretty straightforward, but I've seen a lot of different things be construed to be bodily injury or property damage. Mental anguish can be bodily injury. And property damage kind of speaks for itself. General liability is where you're going to get your product liability coverage. So general liability has two pieces to it. You have coverage for operations that are ongoing at your location. If you own a plant or you have an office, part of general liability is going to pay if somebody gets hurt there. If I walk in and I slip on a banana peel and hit my head, that's a general liability claim. Another part of general liability is the product's liability. So that's really what you guys as inventors, small business owners are going to be concerned about. And general liability, you can either buy it by itself or you can buy it in conjunction with some other coverages. Generally it's property or loss of income, those types of things. They can be packaged together. Any questions? I'm kind of plowing through some stuff that's some strange terminology here. So, product liability. Again, as inventors, as manufacturers, and that's one thing I should probably point out here. When you actually get to the point of bringing a product to the marketplace, the insurance world is going to look at you as a manufacturer. Regardless of who actually builds the widget for you, you are the manufacturer. And that has some important ramifications with respect to insurance coverage. Insurance is all about classifications. That's how carriers derive their rates. So, you're an auto body shop, or you're a school, or you're, a flower shop. That's how they derive that. There is no classification for an inventor. It just doesn't exist, because you have to have some type of product out there in the marketplace in order to gain the benefit of coverage, because without a product out there, you can't really hurt somebody. So that's why you guys are typically considered to be manufacturers. Product liability, again, bodily injury, property damage. There's those two triggers again, bodily injury or property damage, as a result of something your product did or its failure to do something. Causes somebody to get hurt. It blows up. Somebody gets hurt. That's a product liability claim. You make a kid's game and some baby eats the dice and chokes on them. That's a product liability claim. You make cosmetics and people start having allergic reactions to the cosmetics. That's product liability issue. And most of the time, for insurance to apply, you have to be proven guilty. Insurance liability is all about negligence. You caused somebody else harm through something you did that you shouldn't have done, or you did incorrectly. Somebody gets harmed, they come after you. a unique feature about manufacturers is they can actually be held to a standard called strict liability. And that means and this applies to many other high hazard endeavors, but manufacturers can be deemed to be liable for their product regardless of how it is used. Even if somebody is using it improperly, you can still be held liable for it. And it's usually because the product, even if it is being used properly, can still be dangerous. Gasoline, even if you're using gasoline properly, you can get burned. Dynamite, you're using it properly, you can get blown up. Skydiving, you're doing it properly, you can still die. Those are hazardous things. Those have strict liability. As the manufacturer, you cannot use any type of defense to try to say that that claim doesn't belong to you. So just something to be aware of. I'm sure you guys aren't out there inventing the next napalm or what have you, but you could potentially invent a great thing and get in the process of bringing it to market, and then get to the point of insuring it, and the insurance companies go, sorry, we're not going to take this risk on. And then you're left with a difficult position of either giving it up, selling it to somebody else who has the resources to self-insure, or self-insuring it yourself, which most people really don't have the appetite to do something like that. So how can your product fail that can cause these liability situations? It can be faulty design. We talked about that a little bit earlier. In our world, it's called an inherent vice. It's something that is built into the product that causes it to fail. That's there all the time. Bless you. Inadequate labeling. So we all remember the McDonald's coffee, right? The coffee was too hot. It was supposed to be served at 150 degrees. They served it at 180 degrees. Somebody spilled it in her lap and got burned and was awarded millions of dollars, which on appeal was actually knocked down quite a bit, but you didn't hear about that. You heard about all the money that she got. I think she actually ended up getting her medical bills in like $270,000. So it ended up not being a huge deal, but as Roger knows, these things can take a long time to work their way through the appeals process. And in the meantime, the press have moved on. But it's a somewhat funny example, but it has led again to the situation where you can't be too careful when you're labeling your products. You really can't assume that that common sense really exists anymore. You have to make sure that you let them know they shouldn't be doing this, that, or the other with your product. And
that was industry standard violation of McDonald's was running their coffee considerably hotter than everyone else.
Oh, they ran it too hot?
Yeah, it was, and the reason was economic. They got more yield out of the beans, and they can get a little more coffee out of a particular pound of coffee beans. It's a lot of money. That's 33,000 restaurants. So that's what nailed them, because they tested the temperature. Coffee shops and other fast food, everything was quite a bit lower.
Mm-hmm.
So if you drop the temperature 10, 20 degrees, the disparity of the burns is a lot less.
Okay.
That's
So they were in it for the money, which again, to your point, you make
Yeah.
a few cents on each,
Yeah, 'cause,
bag of beans, that adds up.
when you make coffee, you're extracting the oil out of the bean, and that's what gives you the coffee. So the more heat you put in, you extract more oil.
So fewer beans.
Yeah, I don't know. I think it might hurt the taste, but.
Well, McDonald's has never really been too concerned
Yeah,
about that anyway.
no.
So did the lady get
Mhm.
permanently burned? I mean, visually?
Yeah, I think she had 3rd degrees on her legs. And,
It spilled into her lap, didn't it? Isn't that what happened?
Yeah, and there was a blurb that she had passed away, because this was 20 years ago.
It was a
She
long time.
elderly then.
Yeah, 94, I think it was.
Yeah, so yeah, like you say, she just ended up with medical bills and then some compensation, but not millions and millions.
No, and most of those, those runaway jury awards get knocked down on appeal. But again, you typically don't hear about that because it doesn't get the headlines. But again, the point being, you see these labels everywhere now. This was but one case, that led to the existence of that. So that's the inadequate labeling. Warranties, implied warranties or otherwise, can get you in trouble if you make representations that your product is going to do something and it doesn't do that something. You can be liable for that. And one important thing about product liability, again, you don't need it until your product actually gets out there. When you're working on it, you don't need to worry about it. I would probably say, out of an abundance of caution, if you're testing it out, you've got some prototypes out there. Again, depending on the product, it might be worthwhile to start insuring it at that point. But certainly once you're to the point where you're actually getting it into the supply chain, that's when you need to get insurance. But you really don't have to worry about it so much up until that point.
I was wondering if you knew the crossover of when companies get so big they quit getting product liability. Like I know, like Ford and GM, they can't insure because the cars is such a huge liability that they actually just self-insure, right? Because they're so big.
Yeah.
So there's a point where you insure and then you quit, and I don't know what the criterion is. It just, the insurance cost goes so high, they just figure we'll just take the risk ourselves.
Yeah, I think it's a combination of the type of product and therefore the cost to insure it, and of course this, just the assets of the company. I think most companies over, probably $10 million are starting to self-insure at some point, usually through liability deductible or retention. So they might take, on a liability policy, you can do much like you can with your auto or homeowners. You can take a deductible, which is basically, a way for you to have some skin in the game, and you save a little money as a result. Well, I insure a lot of home builders, and they, can take deductibles 100, 250, sometimes $500,000, because they're building multi-million-dollar projects. And it makes sense for them because you get a much better deal on your insurance if you take a high deductible, because most losses are on that small side.
Yeah, they just want to be covered for that over the top.
It's the catastrophic losses, the ones that would otherwise cripple the company, which, it's very similar to your insurance. Most people, or many people, carry $1,000 deductible on their auto because they're not going to turn in every little ding or crack in the windshield that they get, because most people can come up with that kind of money, but most people can't come up with enough money to replace their car if they had to, as if it were stolen or broken or blew up. So the same thing applies to the large companies. They can handle those small losses, but they can't handle the big ones. It gets interesting when you see even these large companies get susceptible to these product liability claims, and maybe their books can't support that. So you really have to be careful when you're looking at self-insuring any kind of endeavor. What can you afford? And one thing we do know in the insurance world is that really big claims are going to happen. We don't know where or when necessarily, but there's enough statistics out there to show that they do happen. Most claims are relatively small, and businesses can survive them, but there are claims out there that businesses can't, and you never really know when your number is going to come up. Alrighty. So that's general liability, and you can buy as high a limits as you want on general liability. And it's not like your home where you're insuring for the value of the home, you know, $250,000, $500,000, whatever it is. Liability claims, there's theoretically no limit to how big they can be. And liability insurance is sold in increments of $1 million. So most policies start with $1 million and you go up from there. You know, IMA insures some, you know, large publicly traded companies, and they might have $100 million in directors and officers limits, you know, to protect them against shareholder suits. So, and they just keep adding these layers and layers on. So they've done the math and they've figured out that $100 million is what they need. So, you know, what do you need as a small business owner, as an inventor? And I think there are really three questions that you have to ask yourself when you're looking at limits. The first one is, what assets are you trying to protect? Because really why insurance exists is to give somebody a pot of money to come and get, so they don't take your house or your business or your 401k or what other assets you or the business may have built up. So it's something that they get instead of that. So the first question you ask is, what are you trying to protect? If you've got a business that's worth $5 million a year, you know, do you need to get $5 million in insurance? Probably not a full 5, but $1 million probably isn't adequate. It's probably somewhere in between there. But that's the first place you look. If you have a $50 million company, you probably don't want to insure it for $1 million a year, you know, because if you have bad claim, they're going to roll through that in a hurry, and then your business is in jeopardy. By the same token, if you have a small business, you're just starting out, not a lot of assets in the business, you don't need to be as concerned with as high limits. Now, again, there are some big claims out there, and they can hang on your neck for a long time. So that's also driven by the type of product you have. Then what is your exposure to risk? So what is your product, and what is the potential that it could damage people? You know, if you're a handgun manufacturer, you're going to have a higher risk profile than if you're making, you know, towels. You know, it stands to reason. So you have to consider what's out there and what could happen as a result of that. And then what is your tolerance for risk? You know, some people will go up to the roulette wheel and put everything on 23. And some people don't go to Vegas, period. So that same tolerance for risk is reflected in your choices when it comes to insurance. Generally speaking, entrepreneurs are more tolerant of risk than the general public. You know, they're willing to put in the time and the resources that it takes to start a business, knowing that the statistics say that 9 out of 10 small businesses fail within the first year. They know that, they still forge ahead. So generally speaking, you guys are going to have a higher tolerance for risk than an insurance person like me, for example. Doesn't always hold true. But those are the three things you really need to look at when considering limits.
Howard, is there any rule of thumb relationship on the limit of general liability I should carry, say, to those sales levels?
Yeah, the interesting thing is general liability is going to pay for anything that happens while that policy is in place. So if your business has been around for 10 years and you've got 10 years worth of product out in the supply chain, the policy this year, obviously as your business grows, there's more potential that you're going to have a claim because you've got more stuff going out there. So it's really what you're looking at backwards is kind of cumulatively, what have your sales been over the course of time? You probably want to look back 5 years, you know, statute of repose and what have you, but there's really no good rule of thumb, and it still really comes down to a question of what are the assets of the business, because it doesn't really matter what your sales are if you've got a $10 million business, theoretically that's the most anybody could get if they got the entire thing, right? Is that $10 million. So even if you've got $50 million worth of product out there, probably wouldn't make much sense to insure,
So you're
50
just
million.
looking at it
It's
as
still looking.
business valuation.
Yeah, that's exactly it. And again, it's really a function of people's risk tolerance. And obviously, you get to a point where your company is of a size that you can't insure it on a one-to-one basis. A billion-dollar company isn't going to buy $1 billion worth of insurance. They couldn't afford it. It wouldn't make any sense. So, there are formulas out there that can help, but really, it's more of a rule of thumb and a, kind of a gut thing as for what the business owner feels should be adequate. Question. So this is a chart that shows basically the distribution of limits, and that tallest bar there is $1 million. And if you add up everything to the left of that, it's about 72%, I think, of businesses carry $1 million in liability limits or less. And this is businesses up to 100 million in revenues. So you've got some big companies in here. And in fact, if you go up to 5 million in limit, that encompasses 92% of all of these companies. So 92% of companies up to 100 million in revenue are only carrying 5 million in limits.
I know this is a distinction sometimes. Is that per claim or cumulative claims over time?
It's per occurrence.
Per occurrence, okay.
So one occurrence, as you know, could give rise to multiple claims. And this $1 million is per occurrence. Now the 5 million, they're getting those limits via umbrella layers. You can't get that on a primary policy, so they're stacking those limits on top of that. So it's increasing that occurrence limit. So if you're a bus manufacturer and there's an accident, or there could be 30 people injured in that bus accident. Each one of those could be a separate claim, but it's all one occurrence. So the carriers capped their loss.
One occurrence is like
It's the
stems
event.
from one event. Okay.
Yeah, that's the event that gives rise to the claim, is the occurrence. So if that was $1 million per claim, and there was no aggregate limit, those could go through the roof. In that same situation, you could be facing 30 million in claims from one occurrence.
$1 million from each one.
Right. So I show this just to show that the vast majority of companies carry $1 million or less. So that's really kind of the point, the starting point, if you will. And most policies these days are priced at $1 million. If you go to Hartford or Travelers or whomever and get a policy, it's probably going to have $1 million limit on it. It's hard to find limits less than that these days.
Do you save that much if you could find something half of that?
It depends. Policies are rated based on the exposures. So, a $5 million company is going to be paying more than a $500,000 a year company. It would not be half the cost to get a $500,000 in limit as opposed to $1 million. Just like it won't be double the cost to get 2 million as it is 1 million. It might be 75% to get another million on top of the first. If you could find a $500,000 policy out there, my guess is you would still pay 80% of the million. Because again, most of the claims occur in actually under $250,000. That's where the most action is. So that's where the companies are taking most of the hit. So for them to go giving you $500,000 limit to $1 million really doesn't gain them that much. Alrighty. So that's the general liability. Any questions on how?
So
Yep.
there's no limit. I mean, I have a business. Someone walks in the front door, they slip and fall on my steps. That covers that, or is that okay? Or a shelf breaks and lands on an employee's head.
Mm-hmm.
That too. Okay.
Well, that would
That might
if
be
it was your
workers'
business,
comp.
it'd probably be work comp, but if you were shopping at the grocery store
And a customer.
and a
a
shelf
fell
broke
on a
and
customer.
dropped, a bunch of bottles on your head, yeah, that's a liability claim as well. And again, there's theoretically no limit to how big a loss a liability claim can be. The classic example is, on auto, you hit a guy who had just passed the bar exam and was getting ready to start his first day at Holland and Hart, and now he can't work anymore. You're looking at a whole lifetime worth of potential earnings, as well as any punitive damages, which aren't insurable in Colorado, but they are insurable in some other states. So it can get pretty crazy. I mean, I've unfortunately, I've seen some multi-million-dollar claims incurred by my clients, and my clients generally aren't that big. They're paying under $100,000 a year for their insurance, which can still be a pretty big company, but it's nothing compared to some of the companies that are out there.
So, yeah, I guess the risk isn't bodily injury. I mean, property damage is, well, like a vehicle accident. I mean, the value of the vehicle is set.
Mhm.
Total it, boom, whatever,
Yep.
15, 20,000. But the medical and the personal injury liability can work that.
Mhm. Yeah, I mentioned earlier I work with a lot of home builders. That's where we see property damage. And you think, well, okay, how does that work? So somebody builds a home 5 years later because the ground has settled, the home's going like this, and there's there's cracks and there's water intrusion and all this kind of stuff. That's actually a general liability claim, believe it or not. And the trigger for that is property damage to the home that you built. It's your product, which there's coverage for that. So there's
Yeah,
a
different from what the homeowner's warranty.
now homeowners warranties are more property policies. If your door doesn't shut properly, it'll fix that, or if your refrigerator breaks, it'll fix that. But most home warranties, they have a very high bar to trigger coverage for structural issues. The house has to be uninhabitable, or it has to be
Yeah, what
unsanitary.
the city condemns it.
Yeah, exactly. And we just don't see that very often at all. So yeah, I mean, there's a claim going on right now up in Erie in the Vista Ridge community, and Zurich, the insurance carrier, has already paid out over $90 million in the claim. And it's all because of these. I mean, they never should have built there in the first place. They should have just turned it into a big dog park, because it's just bad ground. And that again, if you kind of compare it to what you do, the home builder is the manufacturer of that home. They have liability for it. If there was property damage, their policy is going to pay.
Are they still in business then, or is that?
Zurich?
Yeah, whoever built the home.
Oh, well, John Lang Homes was one of the builders up there. They went into bankruptcy.
I would think so.
Yeah.
But I mean, is the bad ground foreseeable, maybe through geological
Mm.
records?
That's a very good question.
Oh,
There, we have really, and I'm sorry, I'm getting off on a rabbit trail here. The soils along the Front Range in Colorado are really not that good. We have a lot of bentonite, which is clay. It expands when it's wet. It contracts when it's dry. House built on bentonite goes whoop when it's wet, whoop when it's dry. You just can't, you can't do anything about it. And the science really wasn't that good 20 years ago. They didn't know how to identify certain veins of this bentonite. They didn't realize that it ran vertically in addition to horizontally, so they'd do a boring and they would miss it because they bored vertically.
Yeah, one spot, yeah.
One spot, but then this moves up and down, the house goes with it. So it's
So how
hard.
do they test it now?
Well, they do more borings, obviously, and
That's the way basement gets.
but that's
6
and
quarters.
that's how they try to identify it. But the industry has really gotten to a point where they pretty much over excavate on everything, which is they take the soil out, they wet it, they compact it, they bring new soil in, they mix it together, and they just smash it down as much as they possibly can. Sometimes they use piers or micro pilings to drive down into the
So
bedrock.
actually, they know the soil they're dealing with. But
Yeah.
before you said-
Yeah. So, but anyway, that's home building in Colorado. Don't get into it. Believe me, there are better ways to waste your life. So that's general liability. So the second type of insurance that might be germane for what you're doing is errors and omissions. And I mentioned earlier, people or things can get hurt or people can lose money. Well, errors and omissions is really for the situation where people lose money. And it's a coverage that responds if the failure of your product or service will cause somebody monetary loss. Roger has professional liability. I have professional liability. It's a form of errors and omissions. We live on advice. If our advice is wrong and somebody makes the wrong decision, or we don't do something that we were supposed to do for our client, they lose money, bam, that's errors and omissions claim. In the same way, if your product doesn't produce the correct outcome. We see this a lot primarily in the software world. So if you were a software designer, you would probably have errors and omissions for your product. If you're designing a new accounting package, and the math inside or the algorithms inside of it don't work, and it gives the wrong answers. People can make some bad decisions. That's errors and omissions. Unless you're developing some type of hardware, technology, hardware, software, you probably won't have to deal with the errors and omissions. Intellectual property insurance. So this is something that Roger can probably speak to here. It's not coverage that's easy to get. It's not cheap, but it is available. And you can get some limited forms of coverage under certain parts of general liability or directors and officers, which we'll talk about in a moment. There's no really standardized coverage form. If you buy a homeowner's policy from Farmers or State Farm or Travelers, they're going to be pretty much the same, as not the case with intellectual property coverage. Each company has their own form. So you have to be really careful when you review them to make sure that you're getting what you think you're getting. And generally speaking, you can buy three types of coverage. You can buy coverage for defense against intellectual property actions. So somebody sues you. They say you violated their trademark or copyright. Policy can provide defense for that. You can also get indemnity for damages, so that person that sues you, the court awards in their favor. It can pay that award. And then you can also get some enforcement coverage, which basically will pay to hire a lawyer to go out and get somebody who's infringing against your copyright. Again, the coverage is very expensive. The minimum premium for one of these policies, I think, is $30,000. So most people don't even worry about it unless they've got something that that the value they put on it is so high that it makes spending that amount of money on it a worthwhile investment.
You're talking 30,000 a month?
No, a year.
Oh, okay.
Yeah.
What, I've heard some cases where people use their general liability for intellectual property, or maybe part of this.
And this is really getting into the weeds. Every general liability policy has coverage A, which is bodily injury and property damage, and then coverage B, which is personal and advertising injury. So in that coverage B, there is some limited coverage for libel, for slander, for copyright, but it has to be in advertising or marketing. So the personal and advertising injury. So you can get some limited coverage in there, but it's not a true intellectual property coverage. It's just a little piece of it. If you I've read of that responding if you had a website and you put somebody else's logo on your website and you didn't ask them permission to do that, coverage B might respond to that.
So if you had a general liability, where somebody came after you, and you didn't have enough insurance, Roger, can they come after your intellectual property after that? Take that?
Yeah, you mean as you. the
As
defendant?
a, let's say an LLC, if you didn't have enough insurance, then they would, start coming
Well,
after your.
that's if they won in court, you got a judgment all the way through that.
Then they could take your patents and your trademarks and everything.
Usually you have those in a separate holding company, and then your operating company's a separate business entity that has the liability. I mean, I think a lot of people do that. They put various assets in various business entities to create some barriers. Like a company will, like if they own real estate, that'll be in a separate company, then they'll actually lease it from that company to make it like an arm's length transaction.
And that's all legal, that's just a good.
Yeah.
legit.
And intellectual property, they'll license
Hmm.
their technology from the holding company. 'Cause I think it helps insulate it.
Yeah, I've never seen a situation where a business was actually awarded to somebody as damages for a claim. Now, you might have to sell that intellectual property in order to pay the judgment, but I'm not aware of a situation where they've just said, okay, you have to give this
Yeah, the
over to.
judgment just sits there as a dollar amount.
It's a dollar amount, right?
Then I guess, it would be the collectors that look at what are the assets,
Mhm.
and I guess real estate, you put a lien on it.
Yeah, so I don't know that it could be forcibly, I don't know that you could be forced into giving that up as a
Well,
judgment,
you would
but you
want
could
to,
have.
because if it's an ongoing business, its value is the state money.
Right.
Generate revenue.
Right, and if somebody's, if they're, if this judgment is being paid off over time, it wouldn't be to, the plaintiff's advantage to put you out of business. They want,
Right.
they want to keep that cash
Well, if you
flow
had a
coming.
great patent, they'd wanna go sell it, right? They'd wanna go, let's sell this thing, make some money, get our money paid off.
Well, but it's still,
Well, it has.
It's still not up to
it has
them.
cover a commercially successful product, so it's who's ever making a commercially successful product. I mean, I guess if like, non-practicing entities, what we call the trolls, people that just hold groups of patents, they don't manufacture stuff. But they were licensing it out to a lot of people, then the patent can sell well on its own, because who's making the product a commercial success are separate entities, not the patent holder. I mean, I guess you can have that situation.
Yeah. Yeah, again, I think the worst case would be you would have to sell that intellectual property to come up to fulfill, the judgment that was awarded against you. But I don't, again, it would be like somebody having to, if you own a building, you have to give that building to somebody as an award. It doesn't really work that way because, again, it's just a dollar amount that you owe. It's not equated to things because, the market value of any commodity is, up to a lot of factors, when you sell it, who the buyer is, what the market is, all those things. So I don't think somebody receiving an award would want to have that award based, have those market factors play into it.
So you're saying most people don't get this because it's so
Yep.
expensive?
Yeah.
So what is the standard, how do most inventors, do they just cover it themselves? They just plan on covering a lawsuit themselves?
Well, these are some things that you can do. That's a very good segue.
Yeah, you're gonna most likely not be a defendant, you're gonna be the plaintiff
Mhm.
going after someone, and then every case is unique. it depends what you wanna do with your alleged infringer. If you want them to stop, you want them to pay you royalty, and you wanna maybe partner with them. You know, and most of the cases settle before they go to court anyway. You know, those kind of disputes, because no one wants to, they don't want the litigation on the books, they don't want the expense and the time and the uncertainty. They just wanna get it done and behind them. And then, you know, it's kind of leaves you in the blank, a guard, because it always says confidential settlements. You
Yeah.
don't know what they really agreed to, who was pulling the strings.
Yeah.
You just know that it went away. It was, when Amazon got their one-click patent in '99, they went after Barnes and Noble for infringement. And then Barnes and Noble said they were gonna validate the patent. And all of a sudden, the whole thing just went silent, and so, and the patent's still around, so.
Yeah, that's one of the reasons why it's difficult to come up with claims data, because I think, what is it, north of 90% of cases end up getting settled, and
Yeah,
most
it's a
of those
very
settlements
small
are
percentage that
confidential.
go to court.
Yeah,
All the way through.
yeah. So, you know, the insurance carrier knows what they paid, and the company knows what they paid, but nobody outside of and the company that sued them knows what they got. But those are really the only parties that know, and they can't tell anyone.
Too bad they don't do that with marriage and divorce.
And I
Like
think
they all go to court.
a lot of companies, especially if they're growing and they're looking to, say, do an IPO or get investors, to have some sort of pending litigation, such a red flag, they wanna get rid of.
Mhm.
You know, because that just, everybody can make it a really bad thing.
Right. Now, even those, you know, those settlements will still show up on a loss history report that you pull for that
Oh, like on
company.
the accounting statements?
No, not necessarily. No, not on the accounting statements, because if it was insurance company dollars to pay the
Oh.
claim, those would never hit the books, right? But every IPO I've ever been a part of, one of the things that's discovered is the loss information from the insurance carrier for those companies. And
Oh,
it's
that's
certain-
part of due diligence.
it's
You
part of
wanna
the due
know what
diligence.
claims were paid for what.
Yeah, and so, you know, each insurance carrier has a record of the claims that they've paid for ABC company. And it goes back, you know, every carrier they've ever had has that. And, you know, they maintain those records. So, you know, anytime there's an acquisition, mergers and acquisitions, they're always asking for loss runs. You know, the due diligence for an IPO, you know, those shareholders want to know what's out there. And, you know, you can't hide from those loss runs. They're there. So that's how they find out stuff that was, you know, dealt with by the insurance company. So since intellectual property insurance is so expensive, you know, there are some traditional non-insurance risk management means to try and manage that better. And that is, you just establish a program to manage your intellectual property. You identify those IP assets that you have in your possession, and then you engage with Roger to make sure that you've got the proper legal protections in place. Use confidentiality agreements with your employees, your service providers, anybody who might have access to that intellectual property. And then, of course, you just keep an eye. You know, the internet is great for this kind of thing. You were showing me all the
Yeah.
pictures of people that are making games just like yours. You
Yeah.
know, it's a lot easier to find people who are stealing your stuff than it used to be.
Yeah. That's where everybody's looking to sell their stuff, so that's why, you
Mhm.
know.
Exactly. Finally, I just want to touch on, and there are a lot of other coverages that would probably be worth talking about once you have a business that's up and running. Not really concerned about those tonight. One that may become relevant is directors and officers insurance, and that's another form of liability. It's another form of coverage for monetary loss, but it generally responds to allegations of mismanagement of a company. All publicly held companies have D&O, is what we call it in the world. And they have super high D&O limits.
I'm just curious, like when this kicks in, like CEO, I made a decision to launch a product, right? And, you know, that's not really mismanagement other than that, but, I mean, does the mismanagement have to be like gross negligence?
It doesn't have to be, but as you know, well, as everybody here knows, there's nothing to prevent anybody from suing you for any reason whatsoever.
Wouldn't
And
this
you're going to get
mostly be,
defense costs.
shareholders?
Most of them are shareholder derivative suits. That's what we see D&O. But we also see D&O come into play with, well, you know, we met at the Rockies Venture Club meeting. You know, these venture capital firms, private equity firms, you know, they're going to want to make sure if they're investing in your company that you have D&O insurance. Because if they lose their investment because of something that some bad decision that you made, now there is a protection if you make what you considered, given the available information, to be the best. It's the business judgment rule, you know that. If you make the best business decision given the circumstances, that's an affirmative defense. But if through your negligence or poor judgment you make a bad decision, yeah, they'll come after you, and there's no defense against that. So that's where your directors and officers comes in.
Is this one, like less expensive relative to the?
Yeah, that was exactly what I was.
Yeah, again, it's going to depend on the product, right? You know, if you've got a ultra hazardous product, your general liability could be through the roof. Directors and officers is rated based on your company assets and basically who's investing in it and how many investors you have. It can be really inexpensive. I mean, it starts at, you know, $500 a year, something like that.
And what, I mean, the shareholder derivative suits, if they sue someone for mismanagement, is it based on what they feel were the loss profits or something?
That's usually it. Yep.
Yeah, I had a business where I actually had a number of businesses where I was with partners, and I had a 25% interest, and my partner had 51,
Mhm.
and he ran it into the ground. And before that, we had a different partner, and that business ran really well for lots of years. So it was obvious, you know, that he made these mistakes. But I never realized, you know, that maybe I could have sued him over this, you know, insurance.
Well, I don't know, how would this apply to like an LLC with members?
Well,
Or this is more the corporate.
This was a corporation.
yeah, and
corporation.
what you can run into in that situation is these can have insured versus insured exclusions on them. You can't sue yourself. That's the underlying notion. But
And gain from it.
yeah, right. But directors and officers, you actually can sue yourself in the sense that your shareholders can sue you. Now, as a owner with that big a stake in the company, 25%, you might not have been able to get this insurance policy to pay. But if you're a minority investor, we see on small companies, that's where we see a lot of action on D&O, is when you have your second cousin who's investing in the company, and they don't really know anything about it. All they know is they're gonna make all kinds of money on it, and they don't, and so they come after you. You know, anybody who's not involved in the day-to-day operations of the company,
Yeah, the armchair investor.
the armchair investor, that's it. And you don't get that in the professional institutional investors. It's the friends and family investors, so to speak, that give rise to a lot of these claims. But one thing to know about the directors and officers, if you are seeking funding through angels, private equity, venture capital, there's a good chance they will require you to carry this coverage.
How about, well, let's say it's a startup and there's one angel. And that angel, they're taking a majority ownership position because they're providing this big chunk of capital. So would this make sense when they're majority owner?
Probably not in that situation. But if that same angel is going to have a 20% position,
Then it would-
20, then it might make sense.
Okay.
Alrighty. And then the last thing I wanted to mention is with respect to service providers. You know, you're going to be working with a lot of different types of people as you're bringing a product to market, and you just want to make sure that those companies you utilize and your trade partners, that they have the adequate coverage as well. If you're using a design firm, you want to make sure they have that errors and omissions coverage, because again, if they do an inadequate design that leads to a flawed product, you know, even if it doesn't hurt anybody because of that flaw, you've lost money because of that. That's an errors and omissions claim. Contract manufacturers, you want to make sure they also have product liability, because as the company that's marketing that product, ultimately it's going to lie. Any claim is going to land in your lap. But if you outsource the manufacturing of that, which you probably will, that company is going to bear some responsibility as well if they manufacture the product improperly. So you want to make sure they have that same liability. And then also fulfillment houses, if you're using them to get your products out to market, you want to make sure that they have the correct coverage. But
This would be different than like, well, if I have a contract manufacturer and I've got inventory or raw materials sitting there and they're stolen or fire or flood, you know, loses all that inventory.
Mhm.
That would be a different.
That's property coverage.
Okay.
Yep, that's that first party coverage. Your stuff gets stolen, blows up, burns up, what have you. You're the one that's borne the loss.
Yeah.
That's what pays for that. But the big thing to take away from this part is no matter who you use to help you along the way, ultimately fault's going to rest with you as the company that's selling, that invented, that created, that is marketing this product. You know, ultimately you're responsible for the damage that it causes people. And then very quickly, one last note just on personal insurance. You know, I mentioned I had a small company when I was younger. My partner was a patent attorney, and we ran the business out of his home for a period of time. You can get some coverage for business pursuits under a regular old homeowner's policy, but is very limited in scope. You're not going to get any kind of product liability coverage. So if you're selling things and those things hurt somebody, if you try and turn that into your homeowner's policy, they're going to laugh at you. And incidental business pursuits may be covered if you're a CPA and you have your office in your home, or you're running a small daycare. That might be covered, but there's usually some kind of limit as to how much money you can make in that pursuit before the coverage doesn't apply, and it's usually a very small number, definitely under $25,000 a year. So you really can't do a whole lot out of your home and expect your homeowner's coverage policy to kick in.
Because they'll usually just claim like anything commercially related, like.
Yep.
Wow.
Well, every homeowner's policy I've ever seen has a business pursuits exclusion on it. And how much coverage you get is in their definition of business pursuits. You know, some will allow you to make up to $5,000 a year. And they'll cover.
The bedroom is an office, the typical thing.
Exactly.
But if a client of mine's coming in there and slips and falls, they wouldn't necessarily be covered under homeowners.
It wouldn't necessarily be, and especially if you're running, you know, if you've got a small manufacturing concern that you're running out of your garage. There's no way it's going to pick. Well, I can't say there's no way. I've seen claims paid that I thought there's no way this is ever going to get paid, and it happened for some reason. But I would not rely on that.
So would you cover somebody that's doing work and business out of their garage?
Well, I guess you'd have to have a separate.
No, I mean,
policy.
would your company cover
Mhm.
them and do the liability? If they were working out of their
Mhm.
garage?
Yeah.
Still works?
Yep.
But it's a policy in addition to.
Yeah. I'm
Yeah,
just
it's
wondering, maybe he's gonna reap it on your garage, and not gonna cover you, man.
No, I mean I write very small policies. I write very large policies and everything in between. You know, again, one of the problems with starting up a business like you guys are looking to do you know, whatever product you're inventing and trying to bring to market, manufacturers tend to pay more, just as a rule, for their coverage than service businesses or office-based businesses. So it can be, you know, the company, the insurance company, they're going to want to generate a certain amount of premium to even write a policy for you, and that certain amount of money may be $1,500 a year, maybe $2,000 a year. Whereas if I wanted to open up my own insurance brokerage, I rent an office, my liability coverage is only $300 a year, no matter how much business I do. You know, just because the higher perceived risk of a manufacturer. So when you're first starting out, it can be, you know, it can be expensive, and then you do really have to consider, okay, what, you know, self-insurance. We talked a little bit about that earlier. If you don't have insurance, you're self-insuring in essence. You are going to write the check if there's a claim, and sometimes people allow that to happen because, you know, they haven't thought through the whole process, and that's what happens. And sometimes it's a conscious decision on their part. You know, they've done the math and they've considered the risk exposure, and they've come to the conclusion that, hey, I just don't need insurance. And that is a, you know, completely valid risk management philosophy. But, you know, I would just say don't allow that to happen without giving it some thought.
I heard one thing. I read it a while back. Some guy in New York, like he owns 4 restaurants, and I think like they would just have general liability, most of the houses. But he's self-insured, but it was like he created a business insurance entity, and he pays premiums into it like he would insure. You heard of a deal like that? But he owns it.
Well, there are, you know, alternative funding mechanisms. I've helped create what's called a risk retention group, which is basically an insurance company that's owned by the insureds, and
Yeah, that's what you call it, yeah.
you actually capitalize that insurance company, and, you know, you buy reinsurance. Every insurance company buys insurance. It's kind of ironic. You'd think, you know, well, they're in the business of selling insurance, but if Travelers, for example, they sell you a policy with $1 million limit on it, they might only pay the first $250,000 in the event of a claim. They actually go out to companies like Swiss Re and Munich Re and Berkshire Hathaway, and they buy insurance on the other $750,000. So that's what you do when you set up a risk retention group. You capitalize that first layer, and then you purchase reinsurance, and you negotiate what's called the attachment point. That's where the reinsurer picks up. And so
It's just like a huge deductible.
in essence, except the value is that risk retention groups, you can get your money back if your claims history is good. So once you've been around for a few years, you're continuing to put money into the company, right? So that pot continues to grow, and you reach a point where you have an amount that's actuarially sound for the claims that you might experience. You know, the first couple years in one of those is kind of dicey, because if you have bad luck and you get hit by some big claims initially, wipes the whole thing out, and then you're really in a bad place. But if you can survive those first couple years, then you hit that point where you've got enough money in the bank to pay the estimated claims, then you can start taking money back. And it becomes a lot more financially advantageous to be a part of that
So
than it
if you,
does.
Yeah, if you have a low amount of claims over a long period of time, it's going to pay off.
Yeah, and you can apply more risk management tactics to it than traditional insurance companies will worry about. You know, the risk retention group I helped set up, you know, you had to implement certain risk, you know, employment and hiring practices, you know, certain nursing protocols that were above and beyond what other companies had to do.
And that was to reduce risk.
Yeah, and to reduce the risk. And the other thing that we did was we did not settle. And you would be surprised how quickly people look for another mark if they know you're not going to settle. Because most plaintiffs' attorneys are banking on the fact that the insurance company is just going to write a check to make them go away. Because, like you said, the longer a claim stays open, the more of a financial drain, the more of an emotional drain it is on the company. Everybody's motivated to get these things over with and move on down the road. So, attorneys, their time is money. So if they know they're going to get dragged into something that's going to take them a long time, they're going to move on to the next thing. So that was kind of our philosophy, and it worked. We had one big lawsuit in 5 years, for 10 organizations, which in that industry was not bad at all. So yeah, there are all kinds of different ways to manage risk. The key is just to make sure you go into it with your eyes open, and that you give it the requisite amount of thought. So that's all I've got. Are there any other questions? Excuse me.
How often do you see where you have to do product testing before you insure somebody?
The only types of products where I'm aware of that any type of testing is required at all is if they're FDA. So if you're bringing, if you've invented a new chair or, a new game or what have you, they're not going to require you to do any kind of testing on it.
How involved are you guys in setting up the warranty or the warnings, that sort of thing on a product?
Yeah, that's not our thing. We're insurance brokers, not lawyers.
Wouldn't you, as a product liability insurer, want warnings on?
Now what they're going to do is they're going to ask you for copies of your warning labels, and then they're going to tell you what you need to do to them. They're not going to say, put this on your product. They're going to say, show me what you're putting on it, and I'll tell you whether it's okay or not. Which I've never had a situation where a warning label was kicked back. So they just want to know that there's something on there. Insurance companies don't. It's kind of interesting. Most insurance companies are in the business of volume. So, they really, especially on smaller risks, they really can't spend a lot of time underwriting a certain risk when you're charging $500 a year for premium.
You can't do much with that.
Yeah, if you touch it more than once, you've lost money on it. So you can, a lot of things end up getting insured that probably shouldn't be because of that. So, but there's enough insurance out there that it still works. Awesome. Well, thank you. Thanks for letting me come. Hopefully it wasn't too boring.
No, there's always things to learn.
Yeah, and I would just say, in conclusion, if you are getting to the point where it looks like you might be getting something out there into the marketplace, just talk to whoever writes your insurance for your car or your home or whatever. They probably do commercial insurance as well.
Mm-hmm.
And hopefully if this isn't something that they can, that they feel comfortable doing, they can point you in the right direction. Or, you can always give me a call if you have any questions. I'll leave some cards behind.
Give us a rough ballpark, let's say like Jeremy's product. It's not inherently high risk. It's not low risk, certainly.
Mm-hmm.
The hook and ring game. His insurance, I know from some prior presentations that the volume of the product sold place, higher volume is going to be more insurance, but you're selling more, making more money, so should be okay.
Mm-hmm.
Is there a point where the volumes, like the insurance cost per unit, starts to decline at super high volumes?
Yeah. And it's usually not a function of, the volume of the product, it's the dollars. Insurance, liability
Like
insurance.
Sales dollars?
Mm-hmm.
Oh.
Yep. So, you know, if you're doing $500,000 in revenues a year, you're probably going to pay the same rate if you do $1 million a year in revenues. So there's going to be a proportionately direct increase in your premium relative to your sales. Once you get to 5 million in sales a year, you're going to start seeing some reduction in rate. And then about, 10 million, 50, that rate keeps going down as you're leveraging economies of scale at that point. There's more exposure to work with, which is easier for the carriers to underwrite. Because there's more money out there, they can do more calculations and come up with better answers to their questions on it. So, but most small businesses are not going to see much of a reduction in rate up to $1 million in revenues.
Okay.
How about the other side of it? If you start out and you have sales of only $10,000 and then it goes to
Just
50
starting.
and 100, where do you see that jump up after $250,000 or?
Well, that small, you're going to be subject to what's called the minimum premium of the policy, and pretty much every policy we sell is a $500 minimum premium. So even if you're doing $5,000 a year in sales, you're going to pay $500.
So at 100,000, would it go
So
up? Or
again, it's really impossible to say, because it is really dependent upon the risk profile of the product. If you're selling, these little puffball things that my girls, can't seem to get enough of, you could sell a whole bunch of those, and it's not going to cause your premium to go up significantly. If you're selling knives, different story.
To little girls.
Yeah, if you're selling knives to little boys, then you really don't do that. You can't insure that. But you never know what an insurance company is going to consider uninsurable or not.
do you have different options if one company wouldn't insure it, or are you yourself just with only one company?
And we're an independent broker, which
Okay.
means we work with all kinds of different
Okay.
carriers. So we're not like Allstate or State Farm or Farmers, who can only sell State Farm or Farmers or Allstate products. We work with everybody, and there have only been a very small handful of instances where I've just flat out not been able to find insurance for something. And it usually ends up not being the something itself, it's the size, because sometimes the risk profile of the business is really a better fit for a different part of the insurance company, and that different part of the insurance company maybe charges $10,000 or $20,000 a year as the minimum premium for their product. So there's no way somebody's going to pay for that. If you're only making $10,000 a year, it just doesn't work. So it's usually a function of the small size that can get it kicked out. Great. Well, thanks again for having me.
Thanks a lot.
Thanks, Robert.
You bet.